Alright, and we are back with another episode of Blockrevision. Today recording offline, as yesterday's there were some problems regarding, I don't know how to explain that. It was a problem that I just keyed in one of the keyboard key that was coincided probably with streaming, and I just haven't noticed that one. And when I just hit another one time, a streaming option that really hasn't switched on, as it was already locked out. I don't know, and it was kind of stupidity of the program I was using right now. Hopefully that won't happen again. But getting to the point, so I'm making a little re-upload, or rather a tweak of what I was about to present yesterday. So I hope there will be many of interesting news for today. So getting to the point, starting out with economy view, and right now heading to news that spooked the market on Monday. US sending warships to Taiwan Strait, and I'd rather think it's the kind of a chicken play where both sides are flexing their muscles, and for now there's just a kind of some exercises, some military exercises, and just showing out kind of a show that is about to show up to the rest of the world that both of these sides, either China or US, are mainly concerned in what's going on in Taiwan, but it's still something that shouldn't really bring us to an escalation for now at least, because both sides are not much of a concern about those exercises. There are just as attached here kind of chicken play, but it's something that may also bring some more bears to the market's price action, at least in the short time horizon. So we are just through this Jackson Hole Symposium, and that brought kind of a more bearish point of view that what market literally has considered. So for now, as Mr. Powell said, it's an unfortunate cost of reducing inflation that we may spoil possibly the labor market very soon. So Powell is trying to, I don't know, just say it's what we see is just a prologue to what may happen in a third and fourth quarter, where this labor market may be hit. Interest rate hikes may get risen even further, and that's why the market is really worried about the future performance that may also reflect on companies' earnings. That's why those indexes are literally recently in a kind of a carnage. So we do know that the FED to restore price stability would mean far greater pain. That's what Mr. Powell also admitted, and that's something that makes us also to think that US may be ready to getting ready for a possible higher slowdown. So that was some of the key points, and I just made a bullet point where the latency and sluggishness seem to be changed. So those high interest rates were being delivered much later than it's supposed to. That's supposed to be right back around on the verge of the summer and autumn time. However, it's been brought to the market about half of a year later. That's why this inflationary pressure has rolled over the market. Hikes still about to get delivered. That's a continuation of my point and what the Fed is finding out, especially with this job market, where in many places you can go into a restaurant, airports, and so on, and find out there are many of signs that indicating that the staff is just facing a shortage of labor. Whenever just you just make a look around, there are some signs of help that is still wanted. So wages are about to get going up, and possibly that's another thing that may bring a further inflationary pressure. For now, Federal Reserve views the mostly observed indicator, the inflation barometer by Fed is PCE index, that recently has been found to get at 6.3%, and over the past decades Fed never stopped hiking before. Fed funds were higher than PC inflation. That's why still we are somewhere in the halfway. Inflationary shocks in EO. As Mr. Zoltan found recently, those deglobalization issues may get even more inflationary than it's supposed to be seen superficially. And what Zoltan said, this is what the new world order will look like. We are possibly somewhere on the verge of a possible Minsky moment. That's my interpretation of a possible bubble to be burst in Europe. Europe that has made a great fault, that was this almost entire reliance on totalitarian country outside of Europe. I mean Russia, in terms of energy sources. If we just consider that economic policy shouldn't get us to the point where we are totally getting to a acute shortage of energy, that would really put in a trouble and kind of a not serious viewpoint on what the German and French policy stands on. So we are on the verge on the possible real problems, and the recession in the EU is getting a perspective of maybe 1 or 2 quarters. UK's doomy scenario. Analysts from JP Morgan recently found out that UK is also on the verge of a recession, that it should fall around a third or fourth quarter. For now, more and more young people are just dropping their jobs, and recently what we've seen, this great resignation phenomenon may get even more real. Possible causes of such a situation is this wage stagnation amid rising cost of living, job dissatisfaction, or safety concerns of the COVID-19 pandemic. So if this market won't get to stable position within next few months, it may bring even more serious trouble for the UK's economy. UK desperately needs physical power in order to get the economy back to the right and thriving trajectory. Bank of England needs to break eventually one of two things. One of them maybe by hiking interest rates and in the aim of reducing this inflationary pressure to break even further labor market or financial conditions. There is no other scenario. One loses, another gets it all. We are talking about China stimulus indicators, and recently China has been this lucky dog that haven't had to really face the hard inflation, as they are producing many of commodities. That's why they are not so relying on many of outside markets. So this one is also very interesting to watch, particularly time given that much of the rest of the world is still tightening. So how it will eventually run out, there is very interesting whether the China will get their PMIs to move back stronger above 50ish. Recently, as a resemblance, we dropped at around 47 points. That means that we are on the edge of a serious slowdown, but jumped back in August, and right now getting more flatline. So will Bank of England or even the Fed be interested in following a similar path of loosening their policy? Not least by not yet by now, as this inflationary pressure right in the West is something that is the major priority for governments to tackle. So what may spike recession in such economies as US? If that happen, loan market that is exposed to lower quality borrowers who are also sensitive to rising rates. So we can find that the BB bonds in HY index is rising. So with this interest rate hikes being delivered, this liquidity of those companies may get evaporated in the time being. This is the interesting chart of the macro compass that the US housing market points to an employment rate more than 6% in 2023. So we can find that this spike right over here indicates and kind of is a leading indicator for unemployment market. That's why I would say have a luck with this soft landing. This unemployment rate may get very, very troublesome, especially with this shrinkage pace of Fed balance sheet that is about to get to the fastest levels ever been brought, and we are about to shrink the balance sheet by about 450 billion this year. Into market outlook, retails recently were smashed. That was observation of recently that back a week ago we were just studying that most of the hedge funds has just extended their bearish positions right during this bear rally, and they haven't mistaken this time, and retails were one that got really smashed. The chart showed liquidity being mainly steered by retail traders by Jackson Hole event, and also by this promise that Fed will start losing their fiscal policy, but that is nothing far from false. United States non-farm labor productivity, that's a kind of a trajectory where we do highly expect this one to eventually make a pivot, and that's why we also be observing this very carefully and let you know what our projections become. Share buybacks still remained stable at the high level. So it's another increase that's also give us some chances to further rebound, but we already through major buybacks, but stocks not recovering in a very strong pace. That's why the further performance may get threatened. Portfolio allocations versus surveyed sentiment, that's a projection where we find this surveyed sentiment is eventually getting better, where equity allocations and margin debt may follow. Diverging earnings, that's showing kind of positivity in terms of stocks 600 and S&P 500 that stopped for a while, but possibly as recession will develop even more, we may find this earnings per share for stocks 600 mainly from Europe stocks to being dragged down. That's why we should be rather very I would say cautious in terms of positioning in those European markets. Let's now have a look at crypto outlook, and another market close stopped. So that was something that the market literally been waiting for. The SEC, however, repeatedly turning away multiple applications for a spot-based Bitcoin ETF. So Bitcoin spot ETF was one of the things that was hitting up the market to some of the extent, and something that may be a catalyst in the next spike of interest, as it gives a bigger chance to have its adoption, cryptocurrency adoption, to speed up. Right now, OpenSea, that was the exchange for NFTs, non-fungible tokens, volume is getting dead, but the market is gaining popularity on and on. So volume has evaporated, but technology is going on, and recently, if we just find out the kind of a resemblance to traditional markets, traditional companies raise funds by going public, offering stocks to the public, whereas those operating on Web3, the blockchain integrated internet, going a similar route by launching a token that people can buy and sell on exchanges. This time, the most active users on Reddit has been invited to picking up the NFTs, and eventually to having this ability to exchange them among users for money, of course, for money, because they are scarce and also kind of a interesting for many of the collectors. So that's very interesting. That's kind of I just called new type of Pokemons, but achieved according to your website engagement. And those avatars can be stored and managed on Reddit's on the blockchain wallet vault. And that's why even if Reddit by any means will have its problems as a website in terms of legal issue or something, those NFTs stored and retained in this decentralized blockchain technology will still be there no matter what the legal issues, how severe it might be. So that's very interesting how this blockchain technology is remaining as a part of long-term plan of more and more companies. In terms of market movers, let's have a look at I'll just need to switch on 1 second. Hasn't keep up. Alright, got it. So this week we already had unemployment rate from Japan. It's still at the very low level. Building permits that are one of the most important leading indicators, showing that right now we are getting in a more severe environment, and we are in a consecutive month of reversion. That's why there are some signs of a possible slowdown. Inflation rate from Germany, this one remains at around 8 percentage level, but it's something that, as we can find, cannot be right now dwindled. So that's German one. JOLTS job openings right now showing that we are in a hiring tendency, but it's not a surprise for us, as we have just discussed this previous week, that we are observing possible more job openings due to also this phenomenon of great resignation. NBS manufacturing PMI from China is yet to be delivered. That's very interesting, as I mentioned. For France, inflation rate and unemployment rate from Germany, and ADP employment change from US. However, there is very interesting gauge from US on Thursday. This ISM manufacturing PMI will let us know what's the condition of US economy, and on Friday all investors' eyes will be turned to non-farm payrolls. So it's very important, especially after a recent spike to 528 points. On a longer time basis, we are hiking. Hiking still, and that's something that may give more room for Fed to interest rate hike even further. So eventually I'm just heading back into a trade idea right now. So our presentation showing us that we should discuss the possible trade for today. So very interesting. It's very interesting. I do observe and find this US 100 that is right now getting closer and closer to this at 12,000 hundreds low points. So it means if we just turn on those indicators and those lines, there is a very nice confluence of indicators. So we are just now trying to respect this trend line, this visible also on this another 4-hour time frame. So with this one inspection, we may find that we should observe a stronger rebound, but those rebound maybe of, I would say, not of that much of the demand being coincided with the action, as we are still kinda far from this supports at 12,000 hundreds. So right now we are starting to respect this line, this trending line that is moving upwards, but I do find such of a kind of market reaction where the week, this lower week of the candle, of the bearish candle, will eventually will get stopped around at those support levels, whereas body of the candle, of the daily candle, will remain above those trend line. Otherwise, I won't consider the position where we are right now as a valid. So the key is next couple of hours. If we just manage, if we slide lower to 1200s and rebound very firmly, quickly on a most important on a decent volume, that would mean we will possibly rebound out of this US 100 and then move forward. Otherwise, if we just crack below those 1200s support, there will be possible another way to get enter the short positions. So I just put my trading board as here, but with this tip that I do really expect this price to validate those supports for a time being of the next 2 sessions. Yeah, at most. So I do expect quick reaction, quick rebound reaction. The highly expected will be building this engulfing pattern that will bring over more certainty to this conviction that this setup may work out. Otherwise, I would rather set an alarm of what's going on with the Nasdaq, but I would possibly stay on the sideline. So in terms of market, we are right now at around kind of a decisive point. I don't really observe right now the position of or rather commitment of traders as this kind of a vogue for now indicator that right now many of market participants are I would say diverged between bulls and bears. That's why I'm just leaving this indicator aside and just focusing on price action merely. So that's it in today's episode. If we just have a look at risk reward ratio, in that case that will be at 3.7. So that's it. Once again, thank you very much for watching, and tomorrow we are seeing each other at 8:45 a.m. New York time. So thank you very much, and bye.